I still believe that in our future, I don't know when, there's a long grinding bear market coming, market more like 1966 to 1982 or 2000 to 2013, where equities go nowhere for, a very long time. And then net of inflation, they actually go deeply in the red. And most people think that's impossible. I don't think it is, but it's probably not anytime soon.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The last time I interviewed today's guest was right after the stock market plunged 20% to its post-Liberation Day lows in April. Wall Street was stunned, as just a few months before, the market seemed unstoppable. Well, here we are, just 3 months later, and stocks have rocketed back to new highs. The fears that panicked investors so much back in April seem completely forgotten. What's going on and what's most likely to happen from here? To discuss, we're fortunate to be joined today by David Hay, the up until recently Chief Investment Officer and Principal at Evergreen Gavekal. He now publishes daily investing commentary on his excellent Haymaker Substack. David, thanks so much for joining us today.
Thank you, Adam. Appreciate the kind comments.
They're very well deserved. I'm just speaking the truth. David, you're one of those guys that when it's been too long since you've been on the channel, the emails and comments start coming. When's David coming back on? So hopefully we're going to please a lot of people today. I also want to thank you because you always make my job easy for me, but you've done it again this time by preparing a wonderful chart deck that you're about to walk us through. So I don't really want to stand too far in between us and your excellent charts there. So what I really got a chuckle out of your cover slide here on this thing. So I'll let you get right to
I
it.
get it up here.
Yeah, but I love how you titled it. Maybe they really do ring a bell at the top. So
There we go. That's the one you want, right?
let's stop right in, start jumping right in here. Exactly.
Yeah, so Jim Cramer is a bit known for being a wrong way Corrigan, putting it mildly, and he's obviously all smiles here back on July 11th. And, you could say the market's kept creeping higher since that time. But of course, back in April, when we last spoke, he was semi-suicidal. And he is really, he's almost bipolar when it comes to his market emotions. And so he's in some ways kind of a valuable contrary indicator, in my view, not only with the market, but with individual equities. So anyway, yeah, and it is, since you brought it up, I remember that, in fact, I went back and looked at the transcript of when we spoke because it was such a chaotic time. And my point was that there were tremendously oversold readings, which we'll discuss a little bit coming up here in the market section. And I thought that we could get a powerful rally, and said that bear market rallies tend to be the most powerful. But I was really only half right, because you got to say, this isn't just a bear market rally. When you go to a new all-time high, it's more than that. So, and I think, to give credit where credit is due, how about our friend Darius Dale, who I know you just had on with Luke Groman. So a little plug for those two brilliant people in one podcast. But Darius was quite bearish, as you know. He'd switched from bullish to bearish before the market really did the meltdown, and then flipped back to bullish. And he's been, I think he was very correct in recognizing some of these changes that we're going to see coming up here in a couple of slides. So, I don't want to act like I was Karnak the Magnificent, maybe just semi-magnificent. Okay, just semi.
Yeah, you know what? Most of my audience is 45 and older, so they're going to get the Karnak the Magnificent reference. But
Okay.
you
Johnny
know,
Carson.
as we bring in more millennials and Gen
Yeah.
Zers, that's going to start going over their heads. But let's stick with the boomer references for now, while we still can.
Like you said, before we start recording, an awful lot of our superstar boomers are leaving this planet, and Hulk Hogan being the most recent.
Right, which sadly that news just broke literally about 20 minutes before we hopped on here for this recording, David. Yeah, and then we had Ozzy Osbourne just before that. So, sadly, I think we're going to see a lot more of that, obviously, over the next decade or two, because that's just math and the wheel of time. But so, anyways, why don't we dedicate today's video to Hulk and Ozzy?
There you go. Actually, about 30 years ago to the day, I almost ran my boat into Hulk Hogan at Lake Tahoe. And it's a good, given his physique, it's a good thing I didn't hit his boat.
Yeah, I would say.
Okay, so let's talk about what we've already been kind of dancing around, which is how different things are now versus a few months ago. And actually, this relates to that podcast I know I mentioned to you before that you did with Brent Johnson, the Dollar Milkshake
Hmm.
guy. Because you guys did an excellent podcast. I think it was late November, early December of last year after the election. And at that point, you were opining that you thought that Trump was going to basically go down the path of Javier Milei from Argentina and really take a lot of severe pain on to rectify a very bad situation. And actually, I don't know if you just saw the latest op-ed by Neil Ferguson on Malay, but it was, he doesn't give praise lightly. And he's just like, this has been one of the most amazing miracles to have seen the hyperinflation come down as fast as it has in Argentina, and now growth very strong. And of course, the Argentinian bond and stock market's been on fire. So it looked like because I think there's a lot of kind of a simpatico relationship between Malay and Trump, and
Right.
yet that's not it. Instead of doing the Malay, now it's almost like he's doing the Erdogan. So Malay is our buddy here, rather flamboyant to say the least. And then Erdogan is the president, Erdogan, the president of Turkey, who instead of curing hyperinflation, caused hyperinflation by stimulating into what was already kind of an overstimulated economy. So as we see in this next one, 5 months ago, I think you would agree, Adam, this is what we were looking at. This is kind of the dominant zeitgeist back then. Short-term
Right. And sorry,
propaganda.
just to connect your Malay uh, eh, connection there. Doge was a really big part of everything the administration was talking about then. And I think in one of the presentations that Elon was giving, Malay came out and handed uh, Elon a golden chainsaw. So, I mean, it was very visible that, hey, we're planning to take a lot of pages from Malay's book. That was then, and obviously now it's a totally different ballgame, as you're saying.
Yeah, that's why you look at these six bullets here of what was kind of the dominant mindset and what we thought was playing out. And I think there, from a market positioning standpoint, it was like, okay, well, we better hunker down because we could be looking at a year and a half of some really nasty stock market performance, bad economy, and doing things that need to be done to help, basically Main Street versus Wall Street, and also to deal with in a more rational way the funding of the government. Because as you well know, before Bessent got in office, he was very critical of Janet Yellen relying so heavily on T-bills to
Hmm.
finance these massive deficits. But now, if you look at the bottom six bullets, it's basically everything has inverted. So it's and this grift off the presidency relentlessly. Maybe that's a little harsh, but you got to say there's an awful lot of monetization going on right now of the Trump presidency that
Hmm.
in some cases may come back to not look so great historically.
Do
But
you mean specifically things like Trump coin and that type of thing?
yeah, well, and all the merchandise too. I mean, he's very good at taking
Right.
advantage of his brand, and
The
maybe
Bibles.
there's illegal about that, but I just think from a presidential precedent standpoint. But even beyond that, what I would worry about is that he's obviously taken the imperial presidency to a new high level. And what happens? I mean, I think conservatives go, yeah, that's great. But what happens when the winds shift and you've got a liberal in office who decides to act in such a unilateral way? I'm not sure
Right.
quite as appreciative of that. But regardless, I don't want to get too far off into politics. And I'm a card carrying independent. I think both of these parties have let the country down horribly over the last 25 years. So I'm not, I feel like I'm almost like what Trump, or not Trump, but Musk, a new party, some kind of a movement that represents the big core, the kind of the common sense majority of this country. But sorry, we'll get off of that. But this is
Well,
relevant.
well, no, hey, real quick, just before you flip, head back to that slide for a
Anytime. Hey,
second.
you're in charge of this, Adam, not me.
No, no, no. Look, I'm going to try to speak as little as possible this time because you've done all the great work here. I peeked at your slides, so I know where this excellent presentation is about to go. If somewhere in there, I would love for you to react, maybe at the end of walking through all these slides, with a concept that I've been tossing out recently, and frequent viewers of my channel are going to probably soon get sick of me mentioning this. But I have interviewed behavioral economist Peter Atwater in the past, and Peter coined the term K-shaped economy, which now is in the popular lexicon, and for very uh, well-deserved reasons. As it continues to be Wall Street's term, which was one of the bullets you had in your previous slide. uh, as assets continue to rise, who benefits most? Well, those with the assets, right? And we're increasingly seeing concentration of wealth, I think, really both in the corporate world, as the big hyperscalers are really kind of hoovering up a lot of the capital, but certainly in society, right? As the top 10%, increasingly top 1%, increasingly top 0.1%, uh, continue to amass more and more of the total societal wealth. And the question that I have started raising and asking is, if we continue on this trajectory, are we in danger of the K-shaped economy morphing into a lowercase I-shaped economy, where all the advantage is concentrated into the pockets of a very few who are really kind of separate from the rest of us. They're prospering, they're protected by their advantages, and everybody else is that long vertical part of the eye, just increasingly getting left behind. So I don't necessarily want to derail you yet, just as you're getting started here, but I would love to kind of get your thoughts on whether you share that concern after you walk through what you're about to walk us through.
Yeah, I heard you mention that to Stephanie, and I think that it's a pretty good analogy. I'm not sure if there's another letter that might fit it even better. I don't know, but it's regardless, there is this bifurcation that's been a hallmark of our economy, unfortunately, for a very long time, and I just see it getting more pronounced. And I think some of these efforts that were to roll it back are either going to be inadequate. I mean, for example, the elimination of tax on tips. You could say, well, that's kind of populist and that's kind of helping the lower part of the K or the lower part of the I. But it's kind of chump change, if you ask me, relative to the other stuff that's going on. And
Yeah,
frankly, I've got some slides coming up here that I think really get to the heart of the matter between student loan debt and also housing affordability. And I think there's a tight linkage, frankly, getting
absolutely.
so yeah, I just see what it's, and that's why you could, one could make the case that you're almost coming to a crescendo where there's only so much society can allow this divergence to occur before there's some counter reaction. And I'm going to postulate where there could be a counter reaction occurring, and it's not, anything on the streets, like riots, but you got to believe we've seen that, of course, in LA here recently, and we could see more as people get increasingly frustrated that they're, for example, never going to be able to buy a home. Who wants to continue living with mom and dad, when you're 40 years old, or maybe you're starting to get your own art magazine. You're still living with mom and dad's. But
Right. And I mean, to be honest, and I know you agree with this, is we're already seeing the cultural expression of this frustration. That's honestly why Trump got into office, and on the other end of the spectrum, it's why Mamdani just did so well in the New York primaries. Right? People are basically saying the status quo is increasingly not working for me. And I guess one of the reasons why I asked my question is because your previous slide, which had this was what was, the game plan 5 months ago versus now. The game plan 5 months ago was much more around, okay, we're really going to try to stop doing the things that have created a lot of this wealth disparity, and it's really going to be Main Street's turn. And to your point, the playbook now is really kind of a lot of like the old playbook, and definitely still pro Wall Street. And even the things that are being given to Main Street, like no taxes on tips, to your point, pretty small order of magnitude anyways. But in practice, nothing's really changing because most people didn't report their tips anyways. They just can feel
good
less
point.
bad about it now.
Well, we'll get to this in the tariffs part because I think this is where you get the difference between kind of a little bit of an appetizer thrown somebody's way as opposed to the full meal deal. And the full meal deal, I think, is not going to be so tasty in that regard. But yes, I agree that it's what's. I think that Donald Trump, because he saw the way the markets were reacting in early April, did a huge 180. Kind of reminiscent, ironically, of what Powell did back in December of 2018. If you remember that, when the market was getting crushed, and he said the tightening was on autopilot, and then right after Christmas, he goes, "Oh, sorry, we're reversing gears," and the stock market took off and never looked back. So what we might look at as perhaps a negative from a long-term societal standpoint in terms of the Trump reversal uh, is actually it's been very beneficial to financial market, at least equity markets. Now,
Yeah,
debt markets are a different story, and I
different
want to
story.
really talk about that.
All right. Well, look, the great segue into going into this. So yeah, just
Okay.
to turn a phrase though, as material as the Powell pivot was back in 2019, we now have the Trump turnaround, which,
There you go. That's a good one. Trump. I should have come up with that. That's a good alliteration. Trump turnaround.
that's just it's from my old marketing days. You can't take the marketer out of the host here, I guess.
Well,
All
that's a
right,
good.
but anyways, thanks for going down that road for me and setting the context. Let's get straight into debts and deficits here.
Yeah, this is still kind of relevant to what we were talking about in terms of Doge. And my little quip there was, I forget, this was a line from a movie or a book way back when we hardly knew you. It was some
Hmm.
individual that had a very fleeting moment in fame, but I mean, it's really going the wrong way. So far in fiscal 2025, the government's on track to spend 600 billion more than last year. Federal outlays are running higher than they were doing during even the peak of COVID stimulus. Government expenditures since 2019 are up 63% versus 42% for GDP. So it's, the government doesn't, as many people have said, doesn't have a revenue problem. Though I've heard David Stockman say we're only getting 17% government revenue relative to GDP. It should be closer to 20. Well, I don't think it's very often been at 20. But really, what the problem is on the spending side, where spending is just, gone ballistic, as it's just indicated, and continues to. That's what's concerning. And then if we look, this is a relatively familiar chart to you, maybe not to all of your viewers, but looking at this connection between the Fed's balance sheet. So, and that term is thrown around kind of loosely. I think most people, well, what does that mean? I mean, a balance sheet could be a good thing, right? Well, it is if it's actually kind of earned, like your balance sheet where you saved and earned a lot of money over many years. But the government, of course, can increase the Fed, I should say, can increase its balance sheet simply by using its digital printing press where it fabricates money out of thin air and then use that to buy government securities, which is frankly what a lot of third world countries have done. I mean, that's getting back to the Erdogan in Turkey and how you create hyperinflation. But it didn't in the first, if you look at that chart, the first half of the 2000 teens, because the economy was very sluggish, the velocity of money was falling. But then come COVID and all those stimulus checks being sent directly to the consumers, excuse me, and the Fed then continues to monetize, buy that debt with fake money, and all of a sudden inflation takes off to the highest level it had since the early 80s. And that was basically MMT. And I remember writing about MMT in early 2019 and saying it's coming. Now, I had no idea it was coming so soon, but that it was going to lead to inflation. And it was a big debate. You had Stephanie Kelton, who I don't know if you've ever had her on her show, but you know who she is. And she was a very telegenic advocate of MMT. And it turned out to be, just the inflationary disaster that even Jay Powell warned about. But they did it. I mean, Jay Powell was, the first Fed chairman to actually practice MMT with, of course, a lot of help from Janet Yellen at the Treasury. So this has, obviously been a very tight linkage between the Fed's balance sheet, the explosion of federal debt, because it kind of facilitates it, right? I mean, if you could drive interest rates down to almost nothing, then you could take on all this debt, and then if there's not enough buyers at those low rates, the Fed steps in. I don't want to get too esoteric, but I think this is why I think more than the cost overruns at the Mayor Eccles building of the Fed's headquarters, I think this is why the Fed is under so much scrutiny. And there's a lot of people who say, yeah, they should have independence, but they should also be accountable. I think that's what Stephanie Pomboy just said. I think that's a brilliant way to say
Hmm.
it. So, and now the Fed's very independence is at risk, and kind of deservedly in some ways. So, but putting aside the Fed for right now, I mean, ironically, things have switched. So you've now, I kind of joked about this in a recent newsletter saying that, Jay Powell was for most of his Fed chairmanship a real dove, but he's now become Jayhawk, and he's
Hmm.
so he's changed his feathers to try to stop, the Trump policies or slow them down because Trump is obviously trying to run the economy hot. This is what Darius Dale picked up on, and pointing out that this, I think he calls it paradigm C, which is basically, he thinks it's to benefit everybody. So, you could say Wall Street's going to benefit more, which makes sense because they have more assets, but Main Street is getting a few bones thrown their way. But whatever, it's creating a lot of stimulus for the economy. Now we'll look at some of the things going the other way. It's obviously not just a one-way street here. And this is happening around the world. As you know, there's a lot of stimulus occurring in China, not so much in Japan, but a lot in Europe. A lot of it related to defense spending. In Japan, even greatly increased defense spending. So there is a a lot of impetus behind this recovery that's going on in the world because a lot of the rest of the world, unlike the US, was pretty squishy up until recently. And so, I mean, China, obviously, but Japan's been pretty moribund, obviously, Europe, the sick man of Europe, Germany. And so there's a revival going on around the world. And I think that's why you're seeing some of these foreign equity markets really start to outperform the S&P, which I think most Americans are not cognizant of, but we can talk about that in a bit.
Yeah. Hey, sorry, real quick, just to
Sure.
throw a concept in here. So I was talking with Simon White
Wait.
of Bloomberg the other day,
Yes.
and the term that he is using, um, primarily in regards to well, more in regards to the rest of the world, but also true to the U.S. and maybe even more so soon, is fiscal QE, right? Which is, basically, the other major world countries are have returned back to sort of, robust slash aggressive fiscal stimulation. US hasn't actually really stopped its version of it. So I just thought that was an interesting way to think about it, right? Because the more fiscal spending you have, yeah, you know, you do goose the economy, you do goose asset prices. Now it comes at a future cost, but in the short term, everybody likes it. Is that sort of what you see us experiencing right now? Is this riding this wave of worldwide fiscal QE?
Yes. Yes. And I think, it is different overseas because, it's rate of change, versus stock. I know that's always kind of a big debate. But for example, if the U.S. government's been running around $2 trillion federal deficits, we're still running around 2 trillion, which looks like it's going to be the case despite that $600 billion increase number that I gave to you. But we are going to have tariff revenue coming in. So let's just say the U.S. is kind of steady state around 2 trillion, but a lot of these other countries are seeing their deficits to GDP go up significantly, even doubling. And so that's where I think the QE stimulus is happening more so than the United States.
Yep.
But I think it's a good segue into this section here because what they have to be afraid of and mindful of is what happens in the bond markets. Because as you start to run the economy hotter, and particularly on more of an artificial basis, and I'm really thinking about what's perhaps happening in the United States, where if Trump gets his way, we're going to force interest rates down to 1% at a time when we've got wage growth at about 4.5%, official inflation that's 2.5 to 3, and probably higher in reality. So you're creating a situation of increasingly negative real interest rates on the short end, which the bond market doesn't like. And if we look at this chart in the UK, I mean, as you know, Adam, you read our research on a regular basis, and I thank you for that. And you know that I'm a huge believer in major breakouts. And the longer the range has been in place, the more important the breakout is. And here's one for the UK bond market going back basically 25 years. And it's not alone. So if we go spin the globe halfway and go to Japan, same kind of situation. It's really the highest the 30-year JGB, Japanese government bond, has been since it was issued back in 2000. I mean, these are shocking numbers.
They are, and that is the world's most over-indebted economy right there we're looking at too, right?
It is. Now, the counter argument is they own it domestically. Almost all that debt's domestic, unlike, for example, the United States, where so many foreign investors still hold U.S. Treasuries, though they're not buyers anymore, as you know. They quit buying on net, other than maybe some hedge funds buying T-bills. But then we look at the US and it's not quite as alarming, but it's pretty alarming. So this is a 17-year, threatening 17-year breakout, the 5% level, which is holding. And so, this is where it could get tricky. You could get a nice snapback from, say, 5% to 4.5 and see a decent rally on the 30-year. So it's not like this is fait accompli, but it is quite worrisome that rates are going to go quite a bit higher. I mean, I think if you break 5, you could be at 6 pretty quickly on
Hmm.
the 30-year, and that would be destabilizing. I think that would be uncomfortable. But even where it is now, so you're well aware, the Fed cut interest rates last year, in the second half of last year, by 100 basis points, one full percent. And what did long rates do? They went up.
It went up. Yeah.
So this is not normal, but it is starting to smack a little bit of what happens with emerging bond markets that were running inflationary fiscal policies and with monetary policies that recently have been, somewhat restrictive. Let's face it, the Fed has been raising rates and doing QT, the opposite of QE. So it's been a fairly aggressive rate tightening cycle. But of course, as you know, they were way behind the curve. They were way late to start raising. So you could argue they really never got them as high as they needed to be. But nonetheless, they're way higher than where Donald Trump wants them to be. So there's going to be a lot of pressure. In fact, I was surprised reading David Rosenberg today. He thinks Powell's a goner. And my belief had been that he'll stay in office until next May when his term runs out as Fed chairman anyway, and that they probably have a shadow Fed, which maybe doesn't matter. I mean, I think what's going to happen is the market is going to start discounting much lower short rates. So I think, as a takeaway, an investment actionable takeaway from our conversation is bet on a steep yield curve. I think the odds
Hmm.
of a steep yield curve are quite good. So what are beneficiaries of that? Commodities, financials. A lot of financials do well on a steep yield curve. The mortgage REITs, which we just wrote up this week, like Annaly and AGNC, or you can just buy the mortgage REIT ETF, REM. Those guys do great in a steep yield curve environment, and they've really been fighting a tough headwind for years. So those could be surprisingly good performers, but I don't want to get too far ahead of this presentation. So, but do you want to stop me on anything there? I know
I
you're
appreciate it. I guess the only question I have here is let's say Trump gets his way, and when Powell is replaced, and I agree, I don't think he's going to truly remove Powell before the end of Powell's term for reasons I've discussed a lot this week already. But uh, in addition to trying to put somebody in there who likely will say yes, sir, and do their best to get rates lower on the shorter end of the duration curve, they want to do that because they've got to refinance, what is it, 7 trillion in US Treasuries this year. So they've got to do whatever they can to lower the government borrowing costs. And even if the long end of the curve starts to not like that and rise, do you think, Trump's new appointee under direction from Trump would do some sort of yield curve control where they would actually start buying bonds at the long end of the curve to bring yields down?
Yes, I think that's a good point that we shouldn't underestimate their creativity and their firepower, frankly. So if the bond market really starts to get alarming, and I'd say 5% is where they're really watching it closely, they may resort to some pretty clever moves. I think the most likely one is what SLR, supplementary leverage ratio among banks, where they allow the banks to hold treasury debt without any reserves. There's already big movement to do that. I don't think it's been quite approved yet, but I think that's just a matter of time. But I think then a question is who's going to want to go out on the yield curve, especially after the experience that those three banks had that failed in 2023, including Silicon Valley Bank, Signature Bank, and First Republic. They were killed. They weren't. It was on bad loans. It was they had too many long treasuries. So that industry learned that lesson. So I don't think they're going to be big buyers, say beyond 5 years. But maybe the government can come up with a way. Maybe we talk about that in terms of the stable coin thing. That I've got that coming up with the presentation. I think that's quite fascinating. Is another way the government's going to finance itself.
Right.
But they're going to have to do something pretty clever. The other thing that I was listening to Judy Skelton?
Shelton. Shelton.
Shelton, thank you. Yes, Judy Shelton. And she was proposing a gold-backed bond. I've long believed that the Treasury market's going to bifurcate into those that are backed by fiat currency and those that are backed by hard assets. And the hard asset bonds will trade at a much lower yield. So I think they're going to be very creative in how they keep this from becoming, really a systemic threat. But I do think the bond markets are, if you're a stock guy, you're really happy right now, or gal. But if you're watching the bond markets, you're kind of on high alert. At least you should be.
Okay. All
Okay,
right. Look,
so
I
let's move
don't
on
want
to
to slow you anymore. I
bonds.
know you got a lot of slides ahead of here.
Not too many. We can go pretty quickly or depend on, but this is just, the idea that the Trump administration wants rates a lot lower. We talked about that. Problem when you get real rates very negative. And so it's interesting on this chart from our friends at Gavekal, since 2000, basically, most of the time, these light blue grayish bars are indicating are times of negative real interest rates. And what you can see is it really hurts productivity. And as you know, that when you've got a stagnant labor force, and of course, with all this outward migration, these deportations that are occurring, the labor force is actually contracting. So you're not going to get labor force growth. You're going to need to have productivity. And this would indicate, I know Lacey Hunt is all over this kind of thing, that
Yeah.
it's not going to happen. And I would also argue, which I know that Lacey would agree with, and Charles Gobb, who created this chart, that when you have high levels of government spending, ironically, it's I've used the term for analogy crystal meth. You get this sugar high, you get this near term high, but then longer term, it actually is growth retardant.
Hmm.
High levels, and it's like a misallocation of capital, and that money would be better used in the private sector than by the public sector for the most part. So not great, really. And so many of the things I think that we look at in today's environment, it's like, okay, well, this is short-term bullish, but long-term, it's damn dangerous and pretty scary. Okay, now fortunately, there are places. This gets back to where you can invest, and because I'm always bullish on something. I think you know that from reading my writings. I might say, look, I'm worried
Yeah.
about the stock market long term, but this is really attractive, and I think we've done a pretty good job on targeting things that have done well in this environment, and maybe especially this year. Emerging market bonds has been a favorite of ours, and they've been crushing developed market bonds for years. And even though in the first couple of years of the bond bear market that started 2020, they struggled too. But in recent years, especially with the dollar now breaking down, these emerging market bonds and local currency are doing much better. I know you had Jan van Eck on recently, right?
Yes.
And he's really bullish on the emerging market debt area. I totally agree. When you look at Brazilian government debt at 15% with 5% inflation, 10% real yield, I just think that's a tremendous opportunity. But we like emerging market bonds in general. And again, back to this breakout thing, emerging market bonds are breaking out to the upside. Your viewers could look at the chart of EDD, which is the Morgan Stanley Emerging Market Debt Fund. Again, these are local currencies, and I think you want local currencies to benefit from a weaker dollar over the next few years. So definitely a place to look. And this is further evidence or support. Emerging market spreads are very high right now relative to treasuries. So it's and like this is actually from Louis Goff, Charles' son, that typically when you see emerging market spreads this high, so that means the yield, just like we looked at with the yield of Brazil. So it's ironic that the U.S. Treasury yield is about that same differential, 4.5 to say 15. So typically, when you have very elevated emerging market spreads, it's because there's some kind of a crisis in the emerging world, and there's not. So that's another reason why I think this is a great opportunity. U.S. corporate bonds, which we at times have loved. I think you know that from reading our stuff. We were really pounding the table on them in 2022, kind of mid to late 22. But right now, spreads are very tight. So not a lot of value here. And, if you just look at the history of these things spike when there's unpleasant surprises. So if things are going to get rougher at some point, you probably don't want to be in, especially in the lower grade part of the bond market, corporate bond.
Hmm.
As far as the economy goes, we've seen
Hey,
JP.
sorry, can I just ask you one question on that?
Sure.
Um,
Ask anything you want.
so there's a fellow that I interview from time to time about income investing, a guy named Stephen Bavaria.
Sure.
And uh, you were yeah, you were just showing there the risk that's in corporate debts, and he does have high yield bonds, in his portfolio, when they make sense for him. But one thing he says that I just think is so interesting, it's such an interesting observation, is he says, a lot of people will get skittish looking at high yield bonds, right? And they'll say, you know what, I know those things are also called junk bonds. I don't feel that comfortable about owning the debt of that company because I'm not sure how that company is going to do, right? Um, and he says, okay, I get that. But then what a lot of these people do is they go buy equities in these same companies, right? Where it's like, oh my God, you're going even further out on the risk spectrum for that same company, right? So there's a lot of high flyers out there that basically have high yield grade debt. But people are buying the equity because, oh, it's a story stock and I think it's going to grow, it's got a great growth story ahead of it. But they're taking on more risk for less protection. I just find that funny in the mindset of the American investor. Do you have any perspective on that?
Sure. Well, first of all, I'd say there's junk and then there's junk. I think a lot of investors are unaware that within the high yield space, double B bonds have almost zero default rates historically. So and yet they trade quite cheap compared to double B. So if you look at risk-adjusted returns going back decades, double B provide the best risk-adjusted returns. That's where we like to play.
Yep.
Particularly, you can also get those that are being, in the process of they're heading toward triple B. So that really creates a nice kicker. They also tend to be relatively short maturities, so you don't have as much interest rate risk. So yeah, I just you got to be careful with the lower quality parts of the market when spreads are tight and if the economy is going into recession. Sorry, which nobody seems to think it is, but as we'll soon see, I think there's more risk of that than the market is discounting currently. But the other thing too, to be fair, if you buy a junk bond and you get an 8% yield, you're going to get an 8% yield unless the company defaults. So your upside is capped. I mean, you might get a little bit of appreciation, but not a lot. Whereas if you buy, some crazy stock that just happens to be running, you might, double or triple your money. So, there is that aspect.
Sure, you might double or triple your money, but then there's also a much greater chance that your money, might go to zero or get seriously impaired, and you're further down the stack. If the company were to go into bankruptcy, right, as an equity
Sure.
shareholder, general, usually you're getting nothing, right? But my point was just humans tend to be poor assessors of risk in general. And a sophisticated investor like you, David, will do all the expected value math on both the bonds and both the equity side of things. But a lot of people will just discount the bonds as being too risky, yet buy the equity of the exact same entity, which actually has a greater risk score. But for some reason in their mental math, it feels safer because it's got momentum behind it or whatever, right? It's one of those idiosyncrasies that from a behavioral economic standpoint, I always find super fascinating.
Yes, and I think it's very environment sensitive. There's times where people won't touch those, lower quality stocks with a barge pole, but I mean, you've probably seen the stats for this year. It's the junk stuff that's outperforming the market by far. So, you do get into these casino-like environments and you can make a lot of money if you remember to sell, but unfortunately, most people tend to put more money in, and then when the bottom drops, the bottom, falls off.
Well, yeah, and I'm sorry, I don't want to take us on too far of a tangent here, so I'll wrap this up. But to me, this is sort of one of the bigger issues we have today of our market investing environment that has been created from all the central planning intervention over the past several decades. Is we have been kind of redlining at or near record levels of speculation in the market for so long that we've basically grown probably not just one, but maybe two generations of investors right now to really be speculators versus investors. And to your point, they don't get that barge pole out to stay away from the risky stuff until they've really been badly burned for long enough that they say, you know what, these things are too dangerous to play with. And we really haven't had those events, many of them, in the past 20 years because the authorities have been so quick to step in and re-stimulate. I guess.
You're totally spot on, Adam. You're exactly right. I've got a good chart about that coming up, but I think that's a very critical point. It's unfortunate because I think it's creating a kind of a deep-seated complacency, a buy the dip. I mean, as everybody knows, it's been rewarded time and time and time again. But at some point, it won't be rewarded. And I still believe, and we talked about this last time, I still believe that in our future, I don't know when, there's a long grinding bear market coming, market more like 1966 to 1982 or 2000 to 2013, where equities go nowhere for, a very long time. And then net of inflation, they actually go deeply in the red. And most people think that's impossible. I don't think it is, but it's probably not anytime soon.
Yeah, I worry about the extent of the collateral damage when that ever does happen at some point in the future, where people they'll slam into that wall doing 100 miles an hour because they'll be fully bought in on buy the dip and all that stuff, right? And then they won't imagine that how long it's going to last because they're going to keep expecting, well, we'll just get rescued from this, right? And then the longer that it goes on and they don't, and they just see their valuations go down and down and down, then you get into that point where the investors really start panicking and then everybody sells. That's when you get a true bear market, which we haven't had in a long time. So anyways, I don't want to take us too far down the field of here, but I appreciate you, kind of clarifying that is a major concern of yours. Just the extreme unhealthy levels of speculation that are now
Oh,
kind of the norm
absolutely.
in the market.
And we'll talk about that here in a bit, and one of the most egregious examples. So, won't spend too much time on the economy. I know you talk about this a lot with other people, but you probably have noticed I call it Jamie Morgan. Sorry, Jamie Dimon, JP Morgan, who's been oftentimes very cautious in his comments, is kind of warming up, and he's having a little bit of a I don't know, cognitive dissonance right now, or just he's confused, and I don't blame him for being confused because I'm confused. I think that the amount of cross currents out there, which we'll see shortly, are very, very hard to discern. But we saw this on the front page of the Wall Street Journal here 12 days ago. Lower recession risk, stronger job growth. We had that non-farm payroll number that came out that superficially looked good. I know you had was it Michael Pinto on, and he was just ripping that thing apart. And I totally agree with him. I think that was an extremely weak number if you drill down. And of course, revisions have been consistently negative for these
Mhm.
non-farm payroll reports. So I think the jobs market is not nearly as strong as it seems. But nonetheless, this is what people are reacting to. And a month and a half ago, it looked like a lot of the economic data was rolling over. Now it's kind of strengthened. So question is this just a blip, or is this, the end of, kind of the first half of the year slowdown, which is, we know the first quarter was quite weak, but it's from my good buddy Vincent Delaware from StoneX, and he's pointing out the 10% year over year growth in compensation. It's heavily skewed by, kind of government related occupations. If you look overall, I mentioned earlier, it's more like 4.5%, and this is a little smaller snapshot, but it does kind of show you how much of, and this was really true in that jobs report that just came out, how much of it was government reliant. And when you look at the private sector, it's a much more flaccid situation. U.S. economic leading indicators, it's another thing that if you want to, in fact, you were brought this up, I was going to ask you about it. I think I heard this right when you were talking to, oh gosh, your guy that you just mentioned, White.
Simon White. Yeah.
Simon White, thank you. And you said something about whenever the unemployment rate goes up as much as it has after an expansion, so not early in a downturn, but after an expansion, then it does tend to go into recession. I mean, it keeps going up, basically.
Mhm.
I don't want to misquote you. You said something along those lines.
Yeah, I mean, it's really just pattern recognition. When you look at the unemployment rate over the past 50 years or more, um, after a recession, it trends down, 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 and then it takes usually a while to base. But once it starts creeping back up after it's based after the basing, when it really starts moving back up again, it just spikes, and then that's heading into the next recession. And if you look at the pattern since COVID, we have spent the past probably 2.5 years bottoming. We are clearly now building momentum to the upside. So the question is if your argument is that we're not going to go back into a high unemployment driven recession, you got to have a good answer to why is it going to be different this time versus pretty much every other time in the past 50 years.
Yes, and I would just categorize that as another one of these things, like the leading economic indicators, that it's at a level where you just always have recessions. And now there have been lower readings than what we're seeing here currently, obviously from this visual. But what's interesting is how long it's been in negative territory, which is really about 3 years.
Hmm.
So it's unprecedented how long it's been. And what you would think is a little odd about this is one of the key components of the LEIs is the stock market. So imagine how weak these would look like if the stock market was doing what it usually does, which is go down in these periods. If you look at all these other periods, there were nasty bear markets associated with all of them.
Right.
Just another very bizarre thing that I just kind of scratch my head and say, yes, I'm confused too. So
One last question for you. So we have lots of indicators like that. Now you're going to walk through a few more. But over the past couple of years, hey, we're in territory that's normally in recessions, but we're not in one, even though some percentage of the country would say, I feel like I'm in one, but we still have relatively low, quite low unemployment and things like that, right? And I know it's multifactorial, but is the biggest factor that we're still just working off the gargantuan amount of liquidity that was shoved into the system during COVID?
I would think so, and also the fact that even though the rate of change is negligible right now in the federal deficit, $2 trillion of deficit spending is highly stimulative.
Yep.
And it's also extremely, as you're aware, this is what the Levy-Kalecki equation that came out about 1910, that there's this high correlation between deficits, government deficits, and corporate profits. And it kind of makes sense because all that spending that occurs, which just really comes out of, well, and right now it's coming out of the bond market for the time being, government borrowing, but it's not private. The private sector doesn't have to, create that money and say in wages, but it's getting the benefit of strong sales because of that government generated liquidity. So yes, I think you're right. I think, like you said, multifactorial, and I think it is multifactorial, but that's certainly one of the things. And also, this gets to the K is that this idea when you raise interest rates a lot, it's actually really good for the rich, right?
It's
People, rich
stimulative to those
corporations,
who own assets. Yeah.
rich corporations. And yet for if you're a consumer that's now, I'll just take a quick anecdote, but it's so unbelievable. We've been American Express customers for a long, long time, and my wife sent in the payment a few months ago, and they didn't get it. It just never showed up. I guess we were relying on the mail. So they charged us an interest rate, and here we've been one of their best customers for years, I mean decades really. The interest rate they charged us was 30%.
Yeah. Unbelievable.
And we could afford it, but there's a lot of people that can't. And so they're just getting squeezed, and we're going to see that showing up here and some charts coming up right away. So,
Yeah, let's make our way there because I want to react to that, but I'll wait until we get to those charts.
okay. So anyway, we've heard consistently, well, yeah, all these surveys have been really weak, but the hard data has been holding up. Well, lately the hard data has been weakening. The surveys have actually gotten a little bit better, but they're still at a very low level. The
Yeah.
reason this matters is typically the surveys lead the hard data. So I would, this isn't like conclusively negative, but I think it's at least something that's a bit concerning. Now we're talking about these delinquencies that are starting to really hit. So the home equity delinquencies, not quite as alarming as some what we're going to see coming up here, but uh, credit cards, here you go. So the credit card delinquencies, so you've heard me say this before, what I've noticed is not only do breakouts work with stock charts and commodities and bonds, works with macroeconomic data. So you've seen a series of breakouts to new highs on these delinquencies, and then now you've taken out the 5-year high back in 2020. So, maybe it's topping out, kind of doubt it, but
Yeah.
definitely something to be concerned about. Now, our
Let,
old favorite student
let me
loans.
just note one thing too before you get to student loans, which is if you were to superimpose a data set on top of this in terms of average APRs charged on credit cards, I believe we're at all-time highs. So we're over 20% on APRs on average, right? So to your point, David, credit card debt has basically, not only are we back at a, whatever 10-year delinquency rate here, but credit card debt has never been more expensive for the borrower. One of the things, and this is going to tee up the student loan part, one of the things that let the delinquency rate drop as low as it did over the past 5 years was, all the COVID stimulus and stuff like that, which people were able to use to pay their credit card bills down with temporarily and whatnot. Of course, that pig is through the python, at least in terms of consumer credit debt, because we're getting back to these, 10-year highs here on this. But people had all sorts of forbearance around a lot of their debt, like the housing chart that you just showed. There were years where people didn't have to pay their mortgage or whatnot, right? That's over. And now the last domino to fall is your next slide, right? Which is student loan debt.
Right. So you can see again, major breakout occurring here. It's probably because there were moratoriums for so many years, but it's a pretty staggering number when we look at, well, let's just look real quickly. Commercial real estate loans, we know that's a disaster. But this is what I wanted to buy now, pay later. People are relying way too heavily on this, I believe. But
I'm right there with you, buddy. I railed about that a lot.
here's our back to student loans because this is why it's such a big deal. We're talking about 45 million Americans have student loans. And what's really disturbing is how many are now 90 days delinquent. So now that doesn't mean they're in default. You probably know the details. I had to look this up, but because I thought, well, this is like defaults. Well, it's not. 31, it means you're over 90-day delinquent, but the default is at 21%. So it's still shockingly high. Currently, that happens when you haven't made a payment in 9 months, then it's considered to be in default.
Right. Yeah.
This is
You
this
got
is
to be
I think
delinquent first before you default, but we're seeing the tsunami in delinquencies now. Yeah.
Exactly. And I think this is very concerning. And I don't think the negative impacts have really started to hit the economy yet. So that's why I think the idea that you can sound the all clear is kind of premature.
Yeah, and real quick before you go to tariffs, I just want to underscore your point here because I think this is really important. And first off, David, I got to thank you again. You are a better student of my interviews than I am. I'm so flattered and grateful that you watch as many as you do and take such good notes as you do. So you've probably heard me talk about this before, and you probably saw the interview I did about 3 months ago or so with Anna Wong of Bloomberg Economics, who really, I think, was one of the first to really put this out there, which is that student loan debt could potentially be the domino that sets all the other ones falling, at least on the consumer credit side, because it was the last loan to go into repayment. A good chunk of those lenders, because it had been so long, they just shifted their behavior, right? What they were going to spend on servicing their student loans, they just shifted over to funding their general lifestyle. And a number of them thought, you know what, it looks like I'm not going to have to pay this back. Biden administration says all this stuff's going to get canceled. So, they basically, reorganized their life around never having to pay this back. So not a huge surprise that once they've gone into repayment, the delinquency rate went from 0 for several years because folks didn't have to pay these immediately to 7%. Your chart there, it's like a vertical, just jump, right? So this is showing here that almost a third of those 45 million current federal borrowers are now delinquent, right? These people just can't pay, and almost all this wave probably is in another couple months going to turn into defaults, right? You delinquent first, then you become a default. And the problem is with student loans is you have to pay these one way or another. You got to pay the government, or else they're going to garnish your wages, right?
You
You
cannot
can't
cancel it through
you
bankruptcy.
can't cancel it through bankruptcy, right? So you have to pay this stuff. So increasingly, as the consumer continues to get pinched, and we have other data besides the borrowing side, consumer spending, that type of thing, we are seeing households getting increasingly pinched. And so, all right, I got to pay this stupid student loan. Well, where am I going to steal that from if I have to? Well, maybe I'll be late on my auto loan this month, or maybe I won't pay my credit card in full, or maybe I'm going to get behind on my mortgage, right? So this is the thing that can create that cascade effect. And I don't think enough people are really aware of this yet. And secondly, and this is another thing that Anna talked about, which is she believes that or calculates that there has been credit score inflation over the past decade or plus. And so, she's heard from a lot of lenders that well, we're not that worried because credit scores are better than they were heading into the great financial crisis. The consumer is more creditworthy. But if you discount back for the great inflation essentially that's gone on, kind of like the real creditworthy score, she's like, it's actually the same or even a little bit worse than heading into the global financial crisis. And she thinks that what's going to happen as borrowers begin, or lenders really begin to become aware of that, they're going to say, "Holy crap, we underestimated or overestimated the creditworthiness of the people we lent to. We're going to have to really start ramping up our credit standards going forward." And so, not only are people going to have more trouble paying their debts, they're going to have trouble taking out new credit going forward. And all of that is going to hit consumer spending. And of course, we're a majority consumer spending economy. So it's just a big risk floating out there that I'm not hearing that many people talk about yet.
Right. And I think to reinforce your point is that in doing the research for this section, what surprised me is how much of an impact a default on a student loan has on a credit score. It's big.
Yeah, it's big.
This
Because I don't think it gets reported until it goes into default. And so it appears as a really big strike on your credit report when it finally does get its way to the agencies.
I agree with you, and Anna. I think this could be, back in 2008, we were pretty blindsided by the whole subprime thing, partially because Ben Bernanke was telling us it was contained, and it turned out to be not contained because as you said, it was a cascade effect, a chain reaction effect, and I think that's exactly what you could see here. And so, yeah, it just if we had the same kind of overall view that we had in, say, 2022, when the majority of economists thought we were going to have a recession, that would be one thing. But we don't. We have a lot of optimism on the economy, and I'd say that optimism is rising right now. So that does bother me, even though I'll concede some of the strong points.
Okay, well,
Tariffs?
totally agree. Didn't want, and just underscore your last point there, and we'll move on. Is yeah, I mean, I think we're kind of at like max optimism right now when you look at the markets.
That's for sure. So
Yeah.
tariffs, I mean, I know that, everybody's been talking about tariffs, but yet now they're here and it's kind of like, oh, well, they really don't seem that bad. But I mean, and of course, this is so fluid. It's hard to really come up with hard numbers that aren't going to change tomorrow or maybe, when we're done talking. But the idea that we're maybe looking at average tariffs around 21%, the highest since 2010, which would be worse than they were in the Great Depression during the infamous Smoot-Hawley era. And per Yale, there's a Yale study that said that it's about a $2,800 hit to U.S. households. Now, Yale's probably very anti-Trump, so maybe that's not an accurate number. Maybe that's an exaggerated number, but it's going to be a hit. I mean, it is kind of like a stealth bat that's being put into place. And I know it's going to be sure not going to be all consumers that pay it, but they're going to pay some of it, maybe the lion's share of it. Well, we won't know for sure till it happens. As far as the stock market goes, I mean, it has been the ultimate Energizer bunny. And I've got a chart coming up here that's kind of to the point that you were making. And I mean, no doubt that's one of the richest valuations ever, but it's been like this. This is to your point, for so long. It's like, well, big deal. Who cares? And this kind of gets to that. I mean, if you look at how long the stock market's been in this very expensive territory. So the blue line is including the magnificent 10, really, 10 largest companies. The dark blue line might be a more interesting one that you don't see very often because what it's showing is that where a lot of the high valuation compared to history is the other 490 stocks in the S&P 500. And I've long believed that the real valuation excesses are not in the Magnificent Seven or 10, but in a lot of these companies that are, lower quality that trade at 100 to 200 times earnings, but they've got a very sexy story. I always like to kind of pick on WD-40. It's not 100 times earnings, but it's like 45 times earnings and it grows very sluggishly. There's just a lot of companies out there where you go, this company normally trades at 15 times earnings, trading at 30 times earnings. And I'm not picking. I mean, I personally think Google is quite a fascinating stock right here, and it's in the Mag 7. So I'm not trying to be a downer on the America's best companies, but on the other hand, Tesla was in this group, and you saw what happened with Tesla's earnings yesterday. I
Mhm.
just continue to scratch my head on Tesla with the terrible fundamentals and still basically $1 trillion market cap. But beyond Dave's opinion, this is much more important. This is what insiders are doing. I know you've had Jesse Felder on a couple of times. He's really big on this. In fact, this is from Jesse. And you can see that when that meltdown happened early in the year, the insiders swung, back to much more on the buy side and now they're extremely bearish, selling like they even exceeded last year, which was a pretty bad set of readings. So I think that should be given more attention than it is. And then market breadth. This has been, once again, a narrow rally and that tends to lead to trouble. So I think there's some reasons why you might want to be a little bit careful and actually give you a couple more. Because when I was on back in April, when the market was in free fall, I said, yeah, you look at the fear and greed index and it's in deep fear. The VIX was like at 60. I think it maybe intraday touched 80. And and as we talked about, there was a global margin call going on. There was forced liquidation occurring
Mhm.
because prices had fallen. That you put those three together and you always get a near-term rally. And that's why I thought the market would rally for a while. But again, it's exceeded what I thought it would do. But here's where the fear and greed is now. Actually, I think it's today 76, clearly back into at least slightly an extreme greed. And also, if you look at margin debt is a little hard to read this red line, but it's way up here. This is a problem that the overall economy has. We just have too much debt. And the question is, how do you deal with that in a way that
Hey,
doesn't?
hey, Dave, real quick, can you just give the 30-second description of margin debt for the viewers that aren't familiar with what it exactly is?
Well, I hope they're not. That's a good thing that they're not. I think margin debt is not something you want to use, especially when the market's high.
Right.
But
It's basically borrowing to buy assets, right?
yeah, I mean, this is what, of course, contributed to the 1929 disaster. People were able to buy on, a 10% equity, 90% margin. So now these days, it's typically if you're going to buy a stock for $10,000 you have to put up at least $5,000. So it's a 50% margin. But it doesn't, if it comes down 20, 30%, then you get margin calls. It's not just done with stocks, it's also done with commodities and debt instruments. And a lot of these debt instruments, the leverage is just ginormous, way more than, 1 to 1, 50% type of margin. they might be leveraged 7, 8, 9, 10, 15 times. And if you get a relatively mild decline in prices, they get wiped out, or they have to come up with money. If they don't have money, then they get sold out, and then the prices just, use your term again, cascade down. And again, that tends to be a great buying opportunity. That's why it's nice to have cash. And I think to be raising cash when the market's really frothy so you can redeploy during times of fear.
Yeah.
But
Hey,
that's
two,
how
two
right
quick
now.
two quick things. So the previous chart there of margin debt where it's at an all-time high, at least in that data set, which I think went back,
What
what,
ways?
25 years. Um, there's the famous Warren Buffett quote, right? Which is it's only when the tide goes out that you can see who's swimming naked.
Yes.
It's sort of, to me, this is a sign of being at the beach, seeing a bunch of people in the water, and seeing a lot of bathing suits on the shoreline, right? Where you're like, I can't say for absolutely certain that these people are swimming naked, but it sure looks like it because it looks like they've all left their bathing suits on the sand, right? The tide hasn't gone out yet, but it's a sign that a lot of people are probably swimming naked, meaning they're much more overextended than they probably want to be in this market.
Yeah, so I think that's true. What I did notice before is this cuts off relatively early. I will try to get you next time a more updated, but
Oh, that's right. That looks
I'm
like it
sure
goes through
we're up here.
2018, but I know it's a higher.
It's way. But it's just this trend that we've seen that's just been up and up and up and up. All right, so
Yep.
but
And sorry.
also,
What? One last thing, just to note too, before you get to the good. Um, I've been hearing from a number of the financial analysts who I interview on this program that, as happened, I think near the end of last year, the price of insurance of a market downturn, meaning like the price of a put on the S&P 500, is now quite to very low on a relative basis. Meaning, I'm just curious, like to get your thoughts on this, but is this a good time as you're looking, at things that you like or don't like, as you've been sharing with us around here? Might this be a good time to actually buy some, puts right now just to protect your portfolio? Plus, they're really cheap.
yes, if somebody is fairly aggressively invested, if they're defensively invested, probably not necessary.
Probably not. Yeah, but if you are long this market, probably buying some of this cheap insurance,
Yes.
we think would make sense. But I don't want to put words in your mouth.
No, no, I agree. I mean, personally, I've got a lot of shorts on, which have been very costly here. They were great earlier in the year. Nobody would want to do what I do in terms of short selling. But anyway, yes, I agree with that basic point. I think that's something. It is cheap to buy insurance right now, downside insurance. And it always is when people are very optimistic and the VIX is quite low, the volatility index. But to be, fair to the bull case, I mean, look what's happened to profits. And of course, this has been heavily driven by the Magnificent Seven or 10. So we're way above these various trend lines. And so that's great. And this really is American exceptionalism highlighted in a very graphic way because no other country has had the kind of profits growth that we've had. Now, in return, I know you were talking about this and what the valuations. So I looked at the top 10 companies, and so that makes us a 10, and it's like a 15, $16 trillion combined value, the
Hmm.
10 companies in the United States. So what is that? That's equivalent to the stock market value of Japan, Germany, France. I mean, I don't know. China's a hard one because they have all these different share classes, but it's multiple market caps of other leading global markets in just 10 companies. So that I guess that profitability better be sustained, but it's been a remarkable run for sure.
Right. And I'm curious, when does a chart like this make an argument that like this is American exceptionalism and this is where you want to play versus this is at an extreme and reversion of the mean says that it should mean revert at some point.
Well, you could have said that for a long time and it hasn't happened. I think what you
Yeah.
could say is the slope is flattening. And so maybe that's a sign that we're kind of at max exceptionalism in terms of U.S. corporate profitability.
Hmm.
I would kind of think so. I don't think tariffs will be great for this, for one
Yeah.
thing.
Now, of course, the AI, folks would say, "Wow, we're at a new a new orbit now in profitability because AI is going to be, making companies ferociously more efficient."
Well, and then there's validity to that view. I mean, you look at Microsoft with its record-breaking profits and it's laying people off. And I think it's laying people off because it feels like AI can do what some of these people have been doing.
Right.
And I think that's true in a lot of companies where there's just a whole set of workers who were previously insulated from these technological breakthroughs who are now kind of in the crosshairs, including a lot of people in the investment business. So,
Yeah, yeah, and to be honest, I mean, I've talked a lot about AI recently, and I would say, you know, push back against that at your danger. Meaning, I'm not saying it's we're going to see profit margins continue to rise, for the next decade or so, but one can make the argument that they could, and so you better have a plan B in case your contrary thesis to that is wrong.
well, and you reminded me of another one of your guests, John Hussman, who you had on a little over a year ago, and his point
Yep.
was it has been this profit margin surge has primarily been driven by interest rates falling and also by tax rates falling. And he said it was more interest rates falling than taxes, but of course the interest rate falling thing is done.
Yep.
That's happening now. Corporate America was pretty smart. They turned out their debt. So they've really been so far kind of insulated from that, but that's going to start to bite. It's already biting, but again, it's that K-shaped thing. It's K-shaped in the corporate world too. The lower quality companies are the ones suffering from these much higher short-term interest rates, which is where they typically borrow. And then
Right.
the tax
And
rates.
that they borrow in general, like a lot of the hyperscalers that are representative of these huge profits don't have any debt, practically.
Right. No, they're a beneficiary of the rising rates on their cash balances, although now they're
Right.
spending enormous amounts of money on AI. And I think there's a big question, will they get a decent return on that? That's another thing that could hurt corporate profitability is, this big spending orgy on AI. Something will change it. But like I said, maybe the most tangible thing is it does appear to be kind of flattening out. So as far as getting to the market, well, we've talked about stock market, but how about what's going on in crypto? And I don't think most of your viewers are really very aware of these Bitcoin treasury companies, and that is what's just going on like crazy right now. There's now 141 of these, so they're copying Michael Saylor and his MicroStrategy, and now we have, if you look at crypto overall, the asset class is $4 trillion. Now you might think, no way can it go higher, but and I know we're running a little bit long here, but I think this is fascinating. The government's embrace, particularly of stable coins. And so you've got Bessent, the Secretary of Treasury's got Bessent saying he'd like to see another 2.7 trillion go into stable coins. Why? Well, because they buy treasuries.
Right.
And
Exactly.
so he needs, you talked about the $7 trillion rollover. He needs buyers. Now, there's a lot of people that like treasuries because they're so short term, hard to get hurt on those. But if you're Tether, what a gift this has been. Because back when interest rates were zero, Tether wasn't making anything on its treasuries or very little because they weren't quite zero. But now at 4%, and they've got I think 150 billion of treasuries, so that's 6 billion of revenue with almost no expenses. So personally, I think what's going to happen is the government's going to get into this game. And they're going to say, well, we don't want to just issue the treasuries to you, Michael Saylor, or I'm sorry, to Tether. We want to issue them ourselves. So somebody can now buy a very safe stable coin from the US government. So the government gets that money for free. I
Yeah.
think that's where they're headed. And I think that's why, I know that Luke Gromen, I don't know if he brought that up when you chatted with him this week, but I think that's where he gets some really big numbers for Bitcoin because there is a multiplier effect. The more goes into stable coins, it almost automatically flows into Bitcoin at say a 6 to 7 to 8 to 1 ratio. So if you put even 5 to 1 on 2.7 trillion, what does that do to Bitcoin? And I'm no Bitcoin mag. I don't own any Bitcoin, but I do get this as a bullish argument for it. And I also wonder if maybe the U.S. isn't accumulating both gold and Bitcoin kind of on the sly, some kind of dark pool where if they do get, now this is a little conspiracy theory, tinfoil hat, but if they do get a huge move in gold and Bitcoin, could that be a windfall for the Treasury that allows it to do a buyback of long-term debt? I don't know, but I'm just, it gets back to what we said earlier that there's a lot of things they can do, the government could do with their printing press and their creativity. And I do think Scott Bessent is a brilliant guy, but he's in a really tough position.
That position, yeah, which means he's got to get creative, and stable coins definitely do seem to be a way to get another marginal buyer of treasuries in there to help sop up the issuance that we're going to see this year. I just want to connect one dot here to your bullet point about I can't remember your exact terminology, but essentially Trump potentially using the presidency for self-enrichment. I did just see a press release the other day that Trump Enterprises or whatever, the family business that his kids are running, that he is purportedly have a Chinese wall between his presidential duties and his family's work. But I think they're increasing their treasury holdings at the corporation of Bitcoin to like 2 billion, I think I read, which just begs the question, look, if his family has such a exposure to Bitcoin, is it really not going to influence his policy decision making around Bitcoin and cryptos? It's a little hard to believe.
Agreed. Agreed. I think it's he's playing a bit of a dangerous game there, but lots of people are these days. And I agree with a number of his policies for sure. I know you do too. So, okay, just we're looking at this MicroStrategy, Michael Saylor's Bitcoin treasury company, and up almost 600% since the start of 2024. But look at this one. This is, well, that's just a chart. Well, yeah, that's his chart. Sorry, I've got this partially blocked. This is what I was wanted to show you, this Meta Planet. So this is an imitator of MicroStrategy. So it went up 2,500% here recently. This is a Japanese hotel company that decided it was going to become a, excuse me, a Bitcoin treasury company. So there's just absolute nutty speculation going on with these things. And there's more coming out every day, which kind of undercuts the whole scarcity argument of Bitcoin. So I think this whole area is going to be wiped out. And I don't mean they're going to go to zero. I should say that because actually MicroStrategy is not trading at a huge premium. I think it's like a 60, 70% premium to the Bitcoin they own. But some of these guys are trading at, 500, 600% premiums to the Bitcoin they hold. And those are the ones that will really get nuked, I think.
Okay, and will it require a drop in the price of Bitcoin for them to get nuked, or is it just a shakeout of the speculative sentiment in that space?
Yeah, I think they'll get clobbered even if Bitcoin goes up a bit. Obviously, Bitcoin goes down sharply. And the thing about Bitcoin is it is very highly correlated to the equity market, particularly the NASDAQ. So in the next risk-off event, it will likely get hit pretty hard as it did in the spring. And I think, frankly, and I kind of wanted to do that back then, is it's a good time to be a buyer of Bitcoin when it gets clobbered. Because I think the long-term story is quite positive for it. And it's taken me a long time to get there. But I just don't want to buy it when it's had a big run-up. Its history is it gets hit really hard in bear markets and corrections.
All
So
right. Well, look, I've been taking notes, David, and I specifically was taking notes on some of the things that you mentioned from an investment standpoint, assets you liked, assets you thought you should stay away from right now. And like the fantastic presenter you are, you anticipated all that. So I'm just reading the bullets here in your closing thoughts, and you've captured pretty much all my notes. So why don't you walk us through it?
yeah, well, I mean, we talked about the hot economy thing that is clearly the goal. They're not taking the pain up front, which we thought they might do, and then be ready to loosen things up for the midterms. So that's just we got to accept that reality. And the question is, how much is this market going to run based on that change? And the yield curve, I don't think there's any question it's going to steepen significantly. There's always a question, but I think the odds are quite highly in favor of a much steeper yield curve. And there are ways to benefit from that. So I think instead of fighting this, we're better off just to acknowledge it and figure out ways to capitalize on it. And I think these mortgage REITs are fascinating. And you really don't want to be in them when the yield curve is steep and going to flat or inverted, which is what happened here over particularly the last 5 years. But
Mhm.
they really do well in this kind of environment. We've been, as you know, big on commodities. We were very bullish on silver, repeatedly bullish on platinum, bullish on palladium, bullish on gold. I mean, these things have had great runs. Oil, which I've liked, has not been good. It's been, stuck, although it's had some rallies that we've advised taking profits on. We were really right about natural gas. I think I even suggested you run that as one of your macro pass pieces last fall or
Yep.
September when it was gas was trading around 2 and had a double basically in just a few months. Anyway, there's been really, it's not just the stock market. I know, poor Stephanie Pomboy is always having to defend her, lukewarm attitude towards stocks, but as she says, I've been bullish gold. And the fact of the matter is gold has outperformed the S&P, including dividends on the S&P for 25 years. So I think she has every right to hold her head high. So, and she's a great lady too. Uh, I do think the market looks like it's going to get hit here near term. I do think it could be just a mild 5 to 10%, but I notice even Darius Dale is starting to get a little bit more cautionary on the near term outlook, but I think he's still bullish further out. But I think you look at overseas, we're so, we got a intense home country bias. In fact, even overseas people have U.S. country bias. I
Right.
think that's going to change. I think there's going to be a reallocation, particularly in Europe. Once summer's over and they come back, they take, basically the whole month off. Those portfolio managers are going to start pulling money out of the U.S. If you look at the emerging market bond funds, they're breaking out to the upside. Look at the uh, EEM, which is the emerging market equity ETF. That's had an impressive breakout, which we flagged here as it happened. We talked about the crazy cryptos that they're going to get slaughtered. And I do think the bonds, long-term bond, there will be rallies. There will be times that you can buy a 5% 30-year treasury, make a little bit of money, but you better be quick because I think the long-term trend is down. And so higher yields, lower prices, despite all the games that are going to be played. So that's pretty much it. Adam, I apologize. We've gone a long time. It's almost like a movie.
Hey, look, a couple of things. One, the length is my fault because I interjected in several different places. I hope it was additive to the discussion. But David,
It always is.
it's such a great general presentation, but wonderful back and forth with you. Don't worry, my audience. I've got to say, I have yet to find their maximum. Yes, every so
We
often,
might
some
have done it today.
no, no. I mean, and every so often I get people who say, "Hey, look, I only have 30 minutes. Try to make these 30 minutes." For every one of those people, I have about 50 more that say, "Please make these longer."
Interesting.
I've actually done. You mentioned like guys like Hussman. I think I did a 3-hour one with Hussman, and I had people telling me they still wanted it to be longer than that. So, don't worry. An hour and 15 minutes. This is right in the strike zone to this audience. David, I can't thank you enough. You're just a consummate analyst, but also a consummate presenter. Like I said, you anticipated in almost every case where I wanted to go, and that's always a great skill to have. For folks that have really enjoyed this discussion and would like to follow you and your work in between now and the next time you come on this channel, where should they go?
Well, you can go to our Haymaker Substack. So, like everybody else, it seems like we're on Substack for better or for worse. And so I think you might have to throw an underscore in there. It should be easy to find with just Haymaker. So that's we'd appreciate it. And we do just something that has become it's relatively new. That's become very popular is our daily. So it's a very quick read. And we actually, even if you're a non-payer, which unfortunately the overwhelming majority of our readers are non-payers, but we still give you at least, roughly a third to a half of that each day. And then we give you a little bit of a teaser on our Making Hay Mondays, which is frankly our most popular piece. That's where we get into, we start with macro and then we try to get into specific ways you can make money, hopefully on our macro viewpoints. And that's, I think that's a little bit unusual. We do have an income focus, as you know, Adam, because
Hmm.
that's where we have, like Stephen Bavaria, we have really done well, just absolutely crushed all our relative. And when I say we, I'm referring to my former company, Evergreen, since I'm now retired from Evergreen, though still a significant shareholder. I'm very, very fond of Evergreen, but it's, I think that especially if the stock market is going to start to struggle a bit, I think it's going to be so critical to be able to get yield you can live on if you're no longer getting capital gains. So thank you.
Well, and
And
yeah,
thank you for reading our stuff.
I've talked about this a lot recently. But if you look at the exposure of Americans to stocks, American investors and their exposure to stocks, the percent exposure to stocks is the highest it's ever been. And it is the highest in the cohort that is the oldest, which is
Okay.
just terrible, right? So you've got the people who should be least exposed to stocks, the most exposed right now. And so, you and I think sort of share the concern that, there may be some pretty material repricing in the market at some point that's going to really damage those people. One, because they're going to lose the most market value because they have the most assets, but two, they have the least amount of time to recover from that.
It's such an important point. I just want to cover this real quickly here that just assume that there's a 30% drawdown, which happens fairly frequently in the stock market. Let's assume some retired individual is, 100% stocks. I know that's extreme, but they're out there.
Yep.
So they're down 70%, but they're also taking out, say, 7% to live on. So now they're down 37%. Basically, it doesn't take much of a bear market to happen to put these folks in a hole they'll never get out of, or it might take the rest of their life or maybe beyond their life expense to try to get out of that hole. So I think it's an incredibly dangerous game for older people to be playing.
I do too. And as I mention a lot with the advisors I have on the program, a really, I think, essential thing everybody should be doing annually is revisiting their financial plan or creating a financial plan if they haven't done one already, and getting really specific about their goals. What are the milestones I want to hit by when, right? And if you do the math, especially if you're somebody who is older and has some assets, you may very well find you don't need to take on the average market risk to hit those goals by the time you want to hit them. You might be able to get to that goal line on the time you want with a much safer strategy, like, having heavier exposure to income assets like you're talking about. And the question that just mystifies me is, why wouldn't you do that? Right? Like, why wouldn't you just sleep better at night knowing that your likelihood of getting a catastrophic loss is a lot lower, and just letting the math get you to over the finish line by the time you want to get there? But too many investors, they just have this ingrained mindset of, well, I have to try to beat the market every year. And the older you are, the more potentially catastrophic that strategy may play out to be.
Well, I'd say it's momentum. Momentum is, and the allure, the intoxication of quick profits is very tough for people to resist. But momentum goes both ways, and I think
Mhm.
that's a lesson that's going to be learned here relatively soon.
All right. Well, hopefully people watching this channel are then inspired to take steps that reduce their vulnerability to that. So, David, thank you. When I edit this, I will put the link to the Haymaker up there on the screen so folks know exactly where to
Mhm.
go. Folks, the links will also be in the description below this video. David, it's just always such a joy and a privilege. Thank you so much.
Thank you, Adam.
All right, well, now's the time on the channel where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by lead partners Mike Preston and John Loder. John, why don't we start with you? I'd love to hear your reaction to the excellent discussion there with David. I'm going to expect that a lot of what he said probably resonates with you guys. I heard a lot of similarities to his thinking and your thinking, but maybe there's some points of difference. What caught your attention most?
Hello, Adam. Yes, thank you for having us again. What caught my attention first and foremost is the tragic loss of Hulk Hogan and Ozzy Osbourne.
Mm,
What a week it's been for people of our vintage, but important figures in life and bigger than life, both of them, right? Anyways, David is always a broad fire hose of perspective on the broad economic picture. We really appreciate his take on things. I think he really nicely highlighted. I think the major news of this year's from an economic and kind of market standpoint has been the very abrupt and dramatic about face in terms of policy signaling. He had one slide up there that talked about out of the gates this year the administration was all about short-term pain, long-term gain. We need to have interest rates come dramatically down and do what it takes even if the market takes a hit. And then of course when the market freaked out, especially the bond market freaked out in April, we saw a pivot, a very dramatic pivot, and now there's basically no more talk about spending cuts and getting the recent one big beautiful bill, basically seals the deal that we're going to see more fiscal irresponsibility. It's a time-honored tradition of both parties of recent years. Looks like more of the same. And the bond market is starting to show that. And he talked very much about this. I pulled together a chart here just to kind of visualize this. This is a chart that looks at three dates this year. Chronologically, the first one is January 14th of 2025. And the reason I picked that's the date this year where the 10-year Treasury yield was at its highest. It was about 4.8%, I believe. And then the lowest point of the 10-year Treasury was April 4th. That's the red line. And then the blue line is as of yesterday. And what you see here is the long end of the curve, 30-year yields, are right back where they were at the high point earlier in January of yields. Yet the 10-year yield has pulled back pretty dramatically over that time frame. So this is the yield steepening that he talked about. And this is really a market that is kind of seeing the policy pivot as one that is likely to be very stimulative, very inflationary, and that's being borne in the kind of the pricing odds of Fed futures expectations. This is a chart showing, over time what the market expected the rate to be, the Fed rate to be come December of this year. And at one point in March through May timeframe, there was and this is at the current rate. So basically, the current rate of 4.5, 4.25 to 4.5, the market was basically assuming zero probability it would stay at that level, meaning there would be nearly 100% probability of a cut by December. Now you can see there's still about a 20% implied probability that the Fed will not drop at all this year. It's not the most likely scenario, but the point, the contrast is pretty stark. And then looking at the other end of the spectrum, come December, the market at one point, and this is, what would the probability, what was the market pricing in as probability of a full percentage point decline this year to 3.25. At one point in the kind of April timeframe, the market was pricing in a full 40% likelihood of that. Now it's essentially zero. So there's only at most about two rate cuts priced into this year, and the odds of that are down even from just a month ago. So this is a market that is pricing in a completely different policy set of circumstances, and that's what certainly the administration's been talking about. How does this play out? Getting to the point of likely asset classes that will do well. David talked about commodities, financials, in a steepening yield curve, international stocks because of a likelihood of pressure on the dollar and inflation. These are all areas that we have not only been invested in, but continue to be very bullish on, not just because of these fundamental backdrops, but the technical momentum and relative strength of these sectors are really, really, really strong right now. Um, I'll pause there. We got a lot to talk about, I'm sure.
Okay. I just want to add two things to your list, maybe three things of what David recommended. So I think even more than international stocks, I think he's even more bullish on international bonds. And it's something that a lot of U.S. investors don't really look at, but it sounds like, on a relative basis, they're very attractive compared to U.S. bonds. And
Yeah,
he's
and we,
actually
we do
quite,
have we do have exposure there too, and that's been purposeful. The real yields there, as you pointed out, are quite attractive. But it's really important. We have exposure to emerging market bonds through local currency funds. So that's another way to kind of have played a weakening dollar, which has been a very strong and consistent story this year to date. That's in no small part why we think commodities and precious metals have done so well. International stocks and international bonds have done dramatically well relative to U.S. Priced assets.
right. And that's, again, this is why a lot of people should consider working with a financial advisor, especially if they're not used to investing in these assets on their own, because the way you're doing it, John, you basically get a twofer, right? You get currency appreciation from the local currency there, but then you also get the superior returns that these instruments are offering. I think the example that David mentioned was like a 15% yield, nominal yield on a Brazilian debt. And to the extent that that local currency strengthens versus the dollar, it's just a tailwind on your returns
Yeah.
there.
Yeah,
Um,
the irony in this, Adam, is the word emerging market bonds normally conjures up, oh wow, really risky, really banana republic-y, right? Ironically, many of these emerging markets have sounder fiscal situations than we do here in the U.S. So you might just call our bonds emerging market bonds, right? Just priced in U.S. dollars.
Yeah, that's Michael Every has that meme he's really trying to get going, which is that DM now equals EM, where basically the developed markets are taking on more and more of the attributes of what we used to think of when we thought of emerging markets. So anyways, I just want to reiterate, he's big on emerging market bonds. He's much more bearish on US bonds, in particular on the corporate side. But the other thing that he and I talked about, I'd love to get your reaction to, John, because I remember having this discussion with you back in, I think it was December. It does seem right now that that basically downside protection on the major stock indices are back to really relatively cheap levels here. And so when we have a market that is stretched as David thinks it is, and I believe you guys think it is as well, those are always good times to be buying insurance anyways. But when insurance is on the cheap, when markets are stretched like this, it's sort of doubly wise to consider purchasing it. Am I actually categorizing the current situation correctly?
Yeah, but I also want to first and foremost remind folks that the best form of insurance, the most robust form of insurance is just de-risking. If you think, like we do, that the market is extended from a valuation standpoint, and certainly we've had a very strong rally off the April lows, there's no better way to provide protection than de-risk by selling down your stock exposure. We're about 45% equity exposure right now, a full third of which is in non-US stocks, and for all the reasons we just talked about. And just because insurance is cheap doesn't mean it's always the perfect time to buy it. What we tend to look for is a market that's starting to erode and start to show some warning signals, and you can burn a lot of money buying insurance prematurely, and there's never a perfect timing. We're probably in the vicinity here pretty soon where we'll be looking for opportunities to de-risk through selling down or adding hedges. We just last week added some hedges. We sold some call options on a sector ETF in the industrials that has had a very strong run, and we saw some exhaustion there, so we wanted to bring some premium in. So, but yeah, we're getting in the neighborhood here where we think, especially with a if we do get a very abrupt spike higher here, despite the backdrop that David talked about in terms of all the economic erosion, that would be a very sound thing to start to consider. And you don't have to be perfect. This is not about perfect. Just like, think about it like you would insuring your house or your car. I mean, you don't want the insurance. You don't want the event that you're trying to insure against happening. You hope you waste your money on your house insurance and your car insurance, but having it there can help protect you from a literal catastrophe.
All right. And Mike, I am coming to you here, but real quick, John, just on this point, in your guys' portfolio management right now at New Harbor, are you A, de-risking, and B, are you upping any hedges right now on, any of the major risk on assets, given the current situation?
Well, we're first and foremost de-risked by being underweighted equities, as I
Yep.
talked about. We did start to sell some call options last week on one of our sector holdings. We're probably going to be looking for more opportunities. So we haven't done a lot, frankly, in recent days and weeks to become incrementally more defensive, but that will probably be pretty soon. We're starting to see some of our broad indicators, start to tire out. Let me just share one just to kind of show you what we've seen dramatic resilience in this market. And this is a chart that shows the percentage of stocks in the S&P 500 that are trading above their 50-day moving average. You can see right now we're at about 74% of the stocks in the S&P 500 are trading above their 50-day moving average. That's a very broad market rally. We'd be concerned if we had this index rally and the percentage of stocks actually trading above their moving average was a lot lower. This is a very healthy, broad, across the board rally. Yeah, there's some non-participation elements in small caps and things like that. But what we've seen here is every bit of recent kind of weakness has been turned back up. Very choppy here. It's been very resiliently strong market here. What we want to see is start to see systematic turndowns like this. You can see these big turndowns. Look what happened here back in April. We got to a level where there was only 4% of the stocks trading above their 50-day moving average. These are the kinds of exhaustion things that we start to look for when to lead our hand to kind of get more defensive, start to put more robust hedges on and things like that.
Okay. Hey, John, sorry, pull that right back up
Yep.
again for a second. I'm
Sure.
just curious. So tell me sort of date-wise, and I'm
Yeah,
just
so
waiting.
this is a point and figure chart, so it's not a linear timeline, but right here is the turn of the year. This is
Yep.
2025, 2024, 2023, right? So 2024 was generally an upward market. You saw this, systematic, obviously there's twos and fro's. Anytime there's a column of X's here, it means the percentage of stocks trading above their moving 50-day moving average in the S&P is increasing. So there's more and more stocks joining the party, so to speak, right? And you saw that general trend higher in 2024. And then you saw, and this is where we got really defensive. We saw this deterioration. We started lowering equity exposure. We were carrying out of the money puts throughout this period. That's why when the market, sold off very hard in the April timeframe, we had some puts that were, very helpful in offsetting risk, and we were much less exposed synthetically, as a result of those puts to the market decline earlier this year. Now, this is a pretty rare event when you see such a sharp and sudden rise here, and that's just speaks to how powerful this rally off the April lows were. And many different things were washed out. Sentiment indicators. You see here, there was only, as I said, about 4% of the stocks in the S&P 500 trading above their 50-day moving average. Very washed out. These are the David Hay talked about this. Bear market rallies can be the most powerful ones of them all. And that's certainly what we've seen here.
Okay, and that's you exactly where I wanted to go. So I think each of those
Oh, here's
columns is a week, right?
no. Again, it's a point and figure chart. So each box is represents a move of 2 percentage points. Okay, and the furthermore, so 2025 turn of the date is right here. You'll see these little numbers here. This 2 is February. This 3 is March. This 4 is April. Okay, this 4 is 5. 5 is right here. May, June. Um, Point and figure charting is not like typical charting where it's a linear time scale. What it tries to focus on is the degree of move, and there's what's called a three-box reversal. That basically, in layperson's term, what that does is it allows the noise to be weeded out. You don't want to focus on every little wiggle and waggle up and down. You want to focus on the durable trends and moves, and that's kind of what these charts can help do. Um, so this is off April. We got washed out in April, and then really, and then over the last, so this is just within April to May, we saw this huge move higher, and then since about May, we've been churning sideways here, meaning that there's been resiliency here in the market. If we saw a market that was starting to tire, even while the indices were making new highs, we'd start to see these percentage of stocks participating above their 50-day moving average start to turn down, even though the index level itself may still be rising. That's a classic major market top when you see the indices start to rise and the participation levels like this start to really turn down. We haven't seen that yet in a meaningful way. It's kind of been very resilient here at very high levels.
Okay, I'm just going to ask my question slightly different, um, and I know it's not cleanly linear the way that you mentioned. Being real honest, I'm still kind of decoding exactly how to interpret this, but
Yep.
is that violent rise, in the X's there and the greens, is that the market reaction to the Trump turnaround?
Absolutely. It's basically so many stocks. So these are percentage. So 18%, 30%. These are the percentages of stocks in the S&P 500 trading above their 50-day moving average. Okay. So it's one thing to talk about the index itself trading above its 50-day moving average, but you can have that, but a very low percentage of the constituents is likewise doing so.
Right.
This is showing that not only was the index, trading above 50-day moving average, but a very sharp and persistently higher percentage of the individual constituents also doing so. And that just speaks to a very broad market and powerful market rally.
Yeah. And again, as you've said here, you're seeing perhaps sort of like David was saying, like the impulse of this rally
Mhm.
looks like it might be slowing down,
Yep,
and there may be some reasons for concern. And Mike will come to you in a second to talk about any you see. But you're saying so far it's still pretty resilient, but merits close monitoring.
exactly right. That's exactly the way we would put it.
Okay. Thank you. All right, Mike, coming to you. First off, anything to add to John's overall reaction to David's interview?
I had a lot of notes here, Adam, but I kind of crossed them all out because you guys covered almost everything. But I guess the one thing you didn't cover was the Jim Cramer headline that he was smiling in the beginning of that video on July 11th. And I got to tell you, out of everything you guys talked about, that's what worries me the most is that here we are as we're recording, it's July 24th, almost a full 2 weeks after that. And Jim Cramer was obviously very emotional and negative at the April lows, like I think a lot on Wall Street were. But really, that's just a contrarian indicator, one of many. And contrarian indicators have bad timing history, so or timing records. But it is something. And I can tell you, this market has been straight up almost every day, and it's something that we're concerned about, but have learned not to anticipate too much. So we will wait for our indicators to develop more distressing signals. I will say that some of our indicators, like bullish percents, which measure the number of stocks that are on buy signals, are seeing some reversals. Some of them at high levels, which is, how should I put it, a way to maybe sit up, perk up a little bit, and pay attention. So we wouldn't be surprised to see some kind of near-term pullback sometime soon. We just don't know when. Nobody knows when. And so we're about 3% or a little more than 3% above all-time highs. Wouldn't be surprising to see some pullback, maybe a percent or two higher, a little bit of a shakeout. I don't know if that lines up with what the type of shakeout that David talked about. But we don't think that the top is likely in here ultimately. Seems like we might have some kind of momentum building or energy building for some kind of further blow off top. But we're going to watch our indicators carefully. We already are at a relatively underweight position in equities, like John talked about. We have started to add some very, very small hedges by selling calls on one of our sectors. We're looking for other levels to be hit in the sectors that we've got for financials, utilities, technology. All of these are on our screens and they're starting to approach overbought levels. So we'll put some light hedges on with the covered calls. But in terms of puts, we haven't put any index puts on. Ideally, we're going to get a squeeze higher, which will allow us to put those on, or maybe we won't. We don't know. We'll take it as it comes. Our system is pretty dynamic. If we were to have a big downside move, we took out some stops, we would take those stops and we would lighten equity exposure into that. So we'll see. So there's the whole contrarian indicator. It was nice to hear David give credit to Darius Dale, who was out of the market, before the big drop back in March, and he got bullish more around the April lows. As far as we know, Darius is still constructive and bullish here. I believe roughly around 60% invested or 60% equities in his KISS strategy. I might be wrong, but I think he's leaning bullish. So
Yeah,
I think that's a good thing.
just to be super clear, because I literally just interviewed Darius 48 hours ago. His model is still bullish. And
Hmm.
last time I talked to him, we went into it in depth. He was maximally long in each of the assets that
Hmm.
the model invests in. So I believe that is still the case today.
That's how we understand it too. And I was just happy to hear David give credit to Darius. I thought that was great, both back in March, April, and now. So we'll see. I mean, Darius's system will react if something changes. Our system will react if something changes, and we'll talk about it here. So, and the other thing that David said that was concerning is that he expects a grinding bear market, much like 1966 to 1982. The market went nowhere. If I remember right, the Dow was around 1,000 in 1966, and it really wasn't until 1982 that we broke north of 1,000 and really never looked back. What we're dealing with right now is what we think is the final hours or innings of a 40 plus year bear market. I'm sorry, 40 plus year bull market. And what we are all worried about is a long bear market. So we wouldn't be surprised to see that happen. We think that the market has to have some little bit of blow off here at some point and then a big down market, much bigger than anyone thinks. And David admits that it's been this way for so long that we're all just kind of yeah, I guess we're kind of numb to it. We're thinking that it's relatively permanent, but it isn't relatively permanent. So just stay tuned in, I would say to viewers, both we and other people like David and Darius and all of your guests will say in relatively real time what's going on. And we're not afraid to give our opinion and share information about what's happening. So I think other than that, you guys really covered mostly everything. So I guess I'll
Okay.
stop there.
Well, a couple quick reactions, and then we'll wrap this up, just because Dave's interview went a little bit long. Um, just funny, interesting, serendipitous day around Jim Cramer. We had the intro to David's presentation, as you mentioned there, Mike. While I was interviewing David, I got an email from Jim Cramer's publicist. He's got a new book coming out, asking me if I want to interview Jim Cramer on this platform. I just thought of all days to get that
That'd be
invitation to do
great.
it.
You
But
should
they
do
would
it.
be, yeah. Well, so folks, I'm actually putting that out to the audience here. I know that a lot of people do not share Jim's outlook of the market, and he certainly has a very polarizing history. And I can certainly understand the people who, their gut reaction is no, I don't want to hear from that guy. But I often, get a lot of comments from people saying, hey, Adam, a lot of your guests are really pessimistic, bearish, whatever. Get some more bulls on the channel. There are very few out there more bullish than Jim Cramer usually. So I always think I take those comments to heart, because I do think it's always good to listen to the side that you disagree with. And so I'm leaning towards inviting him on the program. But folks, if you've got strongly felt opinions, let me know in the comment section below, and I will go with what the majority consensus of this audience is. Um, so real quick, Mike, two things. One, you said that you guys are selling calls. Is that the same thing as writing covered calls?
It's exactly the same thing.
Yeah.
Writing covered calls is the same as selling because it's
Yep.
technically a short transaction. You're writing a contract that doesn't exist yet, really. I think that's probably where that came from because you're not selling something you own. You're creating a short position, which essentially means creating a new contract, selling that out in the market. So exactly the same thing, covered calls and writing calls, same thing.
Okay. And folks, look, if you want to, if that is a term you're not familiar with, but you'd like to understand some of these basics of the more common fundamental ways to hedge, like writing covered calls, go watch the free video that the New Harbor team put together for the Thoughtful Money audience about a year ago on this whole topic of hedging. You can go watch that at thoughtfulmoney.com/hedging. All right, and then the last, Mike. So, uh, precious metals still doing pretty well. Gold has been kind of knocked around a bit. The day we're talking, silver's getting knocked down too, along with gold, although silver's still above $39 an ounce. So I don't think any of us can complain about where it is right now. But I'm curious, one of the things that has been attributed to, kind of the lackluster week that gold has had, at least this week, is that we're starting to see trade deals get announced, right? I think in the past week or so, we've had deals announced with Japan, with Indonesia, with the Philippines. Sounds like maybe a deal with the EU might be getting struck sometime soon. And of course, the administration's been guiding to us that there's going to be a lot more of these, perhaps even a fair amount more the next week as folks try to get in under the early, August deadline. Um, with each trade deal, presumably a little bit more of the tariff uncertainty is getting removed. And people think that one of the reasons why gold had such a good run this year is both the uncertainty around tariffs and people trying to front run the tariffs and stuff like that. So are these trade deals making you any more, sort of shy about gold's future performance here in the near term, or do you have a different opinion?
Not really, Adam. Like you said, we do seem to be solidly above the $3,300 level in gold, or have been for quite a while, hovering around there. As we speak right now, we're at about 3375 or so, so just under 3400. And silver's at 3910, up solidly and comfortably in that 38 to 40 range that we thought was the next stopping ground. So that $40 round number seems to be quite a magnet. I wouldn't be surprised to touch that, maybe go a little bit higher, perhaps
And by the
even in the
way, we
coming
got
weeks.
to we got to 39.90 on silver futures yesterday. So we got about as close as you can get to 40 an
Oh,
ounce.
that's crazy. That's a huge run, really, over the last couple of years. And the silver bulls have been long-suffering people, and all of a sudden they get rewarded in a relatively compressed period of time. It's great to see. I think it's going to go higher over time. So, but if you feel overweighted, if you think that you've got too much, don't be afraid to sell some on the way up. Otherwise, what's the point of owning it? You have to make it feel real, sell some and do something. Telling that to a lot of clients, particularly the ones that are overweighted. And by overweighted, I mean more than 20% of investment assets in bullion. If you're overweighted like that, sell a little bit here, do something fun, have a nice vacation. We've been having a lot of talks like that. That does not mean that we think a top is in on gold and silver. So the ratio of gold to silver has gone from about 104 a couple months ago to 86 now. And so it's silver, it swung back so that it's not as extreme with silver being, a relatively crazy a ratio like that. The only time more than that in the last 10 years that I can see is back in the COVID time frame when we hit 124 or so. So silver's been a good trade. Silver miners are starting to perk up, but our work basically tells us that miners have higher relative strength than bullion, and within bullion, silver has higher relative strength than gold. That's why we have 10% miners in our model, and we also have 2.5% silver bullion. Until that changes, that's the way it's going to be. We may start hedging the miners if we get a squeeze higher. Just after the bell here, you may not have even seen it yet. Newmont Mines just reported earnings. They beat on both revenues and earnings per share. Stock closed at 61.50. It's trading up $2 at 63.55. That's the only mining stock that I know of in the S&P 500. And so that's kind of a positive because Newmont had some negative. The last couple of earnings releases were negative. There's been some mergers and acquisitions in the mining space as well, with Royal Gold buying Sandstrom. There's a couple other deals as well. And so maybe some of the easy early money is off the table with miners and bullion, but frankly, I wouldn't be in a rush to sell down this sector. So we're selling down slowly, graciously for people that are overweighted, but still believe that there's some upside left here. Silver to the low 40s. I still think the gold can get up to 36 to 38 in the next maybe 6 months, and that would mean silver into the mid 40s. And so, yeah, we'll be talking about here every week.
Okay. Very interesting to hear about Newmont. I'm just going to predict, I think we're going to see a lot more of that over the course of this earnings seasons from a lot of these other miners. The conditions have just been getting fantastic for them, right, in terms of how far the precious metals have appreciated while their operating costs have by no means grown nearly as fast. So we've kind of been waiting for that moment where the industry proves to Wall Street, hey, you can't ignore me because we're just being so profitable. And that's an important step along the way. Okay, John, coming to you, and we got to wrap things up here. Just any last bit of words you might have for the audience. I always like to conclude these conversations with you guys about, is there anything that's really popping up with your client or prospect interactions here, just that you're hearing from regular investors that, you want to give anybody advice on?
Yep. We've had a steady flow of conversations with what we're doing. We're deep into reviews with clients, and we've been having very productive and helpful and holistic reviews with our clients. It's been quite a year, and many are surprised to frankly see that they're doing so well, given how scary things looked earlier in the year. So we're very happy to be having these conversations. It's we're always hesitant to victory lap because it's always what the future holds, not what the past holds for our line of work. But we were having some really interesting conversations with, we've a lot of folks, frankly, Adam, reach out to us through your endorsement, and we're very grateful for that. A lot of the conversations are just, we think, hopefully helpful conversations that they can take a nugget of value, and we're happy to have a complimentary conversation. Some of those conversations do turn into client relationships, and that's because those folks have selected that we have added something to their picture, and we're very grateful for that as well. But there's a general, unease. People are untrustful. They see headlines and actions that don't kind of jive with what the markets are doing. The headlines are saying one thing, the markets are doing another, and that just creates dissonance in the human psyche that we as humans don't like to have. So it's helpful when we oftentimes have these conversations. We'll pull up a video screen. We'll share some of the charts that we look at and help them kind of see what we look at, and help to just remind them that it's really important to bring real data into the equation, not just emotion, because emotion, time and time again, there's been studies that show pure emotion can cause you to do exactly the wrong thing. It's the kind of thing that leads you to buy high and sell low, and not the opposite. And that's generally been the tone of our meetings with folks these days.
Okay. Well, very much appreciate that, John. All right. So in wrapping up here, first off, folks, if you enjoyed having David on the program, Dave and I have actually been talking to you about having him kind of come on a little bit more regularly. And he spends a lot of his time, researching individual companies and things like that. And he wants to, let me put it this way, he's open to opening the kimono even further when he comes on about, kind of giving actionable direction. If that's something you're interested in, let me know in the comment section below, and we'll work on trying to formalize that. But in the immediate term, if you'd like to see him come back on the program in any way, shape, or form soon, let us know by hitting the like button, then clicking on the subscribe button below. As a reminder, we're almost at the end of July. We're trying to hit that 150,000 subscriber goal. So if you are watching and are not yet subscribed, please do hit that subscribe button. It only takes you a second. If you are a DIY investor, I am a regular reader of David's Haymaker Substack. And so highly recommend that you check that out if you are the one who is managing all your own trades. But if you are potentially looking for a financial quarterback to basically be the primary manager of your financial wealth, and as I say many times, I think most people watching this channel would benefit from that, because that allows you to focus into the things that you're best at, like earning your money, taking care of your family, etc. If you have a good professional financial manager who's doing all that for you, great. You should stick with them. Don't mess with success. But if you don't have one or would like a second opinion from one that this channel thinks is good, then I highly recommend that you consider scheduling a free consultation with one of the endorsed financial advisors that Thoughtful Money endorses. These are the firms that are on the channel with me every week, like John and Mike here with their firm, New Harbor Financial. So if you'd like to schedule a free consultation with one of those firms, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitment to work with these firms. It's just a free public service that they offer. And they're going to tell you what they think you should do based upon your personal individual situation, as John was just telling us. So anyways, John and Mike, thanks so much for another great week. Again, really enjoyed David's conversation, but really enjoyed how you guys built on top of it. And as you said, John, this is a situation, given how stretched it is, that requires really close monitoring it. So you guys will be back on week after week to let us know what you see. Really looking forward to seeing what you see next week and how you guys make sense of it for us. So we'll leave it at that. But thanks so much, gentlemen.
Thank you
Thank you,
very much,
Adam.
Adam.
We'll see you next week. Always a pleasure.
All right. And everybody else, thanks so much for watching.